So starting out with valuation terms, we're going to start with the most commonly asked one, which is cap rate. What does cap rate mean and how is it used? All cap rate is it's a metric that investors like you and me use to determine the value of what a building is worth. And I'll show you how we use it when we go through what NOI means. So to give you an example, let's say a building produces $100,000 a year of net operating income or profits from that property after the expenses have been paid, and we divide it by a 6% cap rate. That means the value of this building is worth $1.666 million. Meaning if you bought the building for $1.6 million without using any loan, it would produce $100,000 a year of net profits. Now we just hit on it. NOI stands for net operating income. This is a huge metric to understand when first getting into the business. Again, all it is collecting all of the rents and all of the other income. That's your income, and you subtract the operating expenses like insurance, taxes, and management fees to come up with your net operating income. So again, NOI divided by cap rate equals value. Now, vacancy, this is very commonly understood. All it means is the time that your building is empty. If you have a 10-unit building that you own and one person moves out, you have 9 out of 10 people living there, which means you're only 10% vacant. And the last term, which is one of the most important ones to understand, is upside or potential profits. And so oftentimes investors like you and me will look for a $200 or a $300 rent increase that you can achieve at the property by doing some sort of renovation or managing it better. That's what's referred to as upside. And to simplify what you're looking for when you're evaluating a deal, you're most likely looking at a building that has a current income in place, meaning current NOI. You apply a cap rate to determine what you can pay for it. And then really how you determine if it's a great deal is you look at what the net income in the future could be after you're done renovating it to determine what the future value is. If you buy it for $1 million and you can sell it for $2 million, that is a pretty good deal. And to be able to understand that is starting by understanding these terms. Now moving into financing terms. Whenever you're getting into these big commercial buildings, most of the time you're going to get a loan. Now it could be from a bank, it could be from an agency, or it could be creative and be like seller finance, but you still need to understand how financing works in this space because lenders can tell if you're brand new, and it all starts with being able to understand the lingo and know what they look at as the lender. So the biggest term you need to know is DSCR. It stands for Debt Service Coverage Ratio. This is essentially a metric that a lender looks at to make sure there's enough existing income in place to support the loan and the interest payments that you're going to be making on that property. And an industry standard is 1.25, meaning if you have a loan that costs you $100,000 a year of payments to the bank, the property has to generate at least $125,000 of net operating income to be able to support that loan, or 1.25% greater. And this is more important than the actual borrower myself. It's not based on my income and my credit score. It's based on the asset since you're getting into commercial real estate and not residential. Now, something to note with this DSCR is it's not only on the interest-only payment. So if you're getting a loan for $1 million and you're borrowing the money at 6%, that is the interest rate. This DSCR metric is used based on a principal and interest payment. We're factoring in the amortization. To make it super simple, if you take the interest rate that you're borrowing the loan at, which is in this case it's 6%, and you add on 1.485 as a rate factor, that factors in how much of a principal pay down that you'll be making along that term. That's how you can get to your P&I all-in payment rate. So if I'm borrowing at 6 and I add my rate factor on, I'm going to take the loan amount and multiply it by 7.485 to determine my annual payment. Now, next one up, which is super important and a lot of people miss, is prepayment penalty and understanding the cost associated with getting out of the loan. There is a fixed step down, meaning it's 5% this year, 4% this year, 3% that year, and it eventually goes down to 0. And now moving into the last one, which is sponsor. At the very beginning of your career, even still today where I'm at, we need other partners that can come on and sponsor the loan to get into these deals. Because as long as the deal has a good DSCR and it qualifies from the deal level, you still need to be able to qualify from a sponsor level, meaning you have to have enough experience, liquidity, and net worth to be able to sign for the loan. If I'm doing a $10 million deal and it has a $7.5 million loan, I need a net worth of $7.5 million or 750 grand of liquidity. And if I don't have that, which I don't, then I can go bring in other partners that do qualify for that, and us together have a combined net worth of over $7.5 million. We can now qualify as a sponsor. So at the very beginning, you need people to partner with. That way you can get on these loans unless you're only doing seller finance. Now moving into the third section, which is the investment terms, we're gonna start with return on investment. And you're gonna hear often AAR and IRR associated with this, which means annual average return or internal rate of return. It takes into account timing and when you get your money back on a refi and when you sell. But to simplify this, all it means is what is the return on my investment? That's what investors care about the most. Over what period of time are they achieving it in? That is the second one, which is hold period. So often terms, whenever an investor is going to go look at a deal, you're going to look at the projected annual returns over a certain hold period. So it might be a 3-year, it might be a 5-year, it could be a 7 or even 10+ year long hold period. And another one that you'll see often is equity multiple. All this means is if I give you $100,000 to invest into a deal, how much do I get back in total? Do I get back 150 and get a 50% return or profit? Or do I get back 200? I give you 100 and I get back 200. That's considered a 2x equity multiple, which is a pretty industry standard. That's 100% profit over whatever hold period we held it. So equity multiple is simple as I give you 100, how much do I get back over what period of time? And then last one is being value add versus buy and hold. This is essentially the strategy that the investor or the person that you're investing with is implementing at the property to achieve these types of returns. We are value add investors going out and buying great deals, improving on them, increasing the income and increasing the value. And we force our returns. And finishing up with number 4, which is deal structure terms. This is extremely important. I've seen plenty of investors get screwed because they don't understand the investment terms that they're agreeing to. Even though that the deal could be a kick-ass deal and be the best home run ever, the person that's structuring it could be doing it in such a way where they're getting 99% of the lion's share and you are getting taken advantage of. So it's important to understand. A couple of the terms is PPM and subscription agreement. PPM stands for private placement memorandum. When you're investing as a passive investor, you're investing into a security, and that security has to be ran through the SEC. A part of that is having a PPM or a private placement memorandum, which is essentially the playbook for how the entity or the fund that you're investing in is running. It outlines what types of assets they have, what their business plan is, where they're at, who's managing it, and the terms within. The subscription agreement is essentially the contract that you're signing, agreeing to acquire units of that certain entity or fund. So these are the legal docs that you'll be signing to make an investment. If the person that you're considering doesn't have a security registered with it, you have to understand what you're getting into because it means you're doing a joint venture, which is completely different. And then generally within this structure, you have fees and profit splits that are associated with it. Like we are an active firm, we partner and raise money from investors. We have a profit split and a fee structure that we charge for all the deals that we do. Again, for us being active and making it passive for the investors, that's how we make money, by performing and generating returns for them. And so within this fee structure, you have what's called an acquisition fee. This ranges between 1 and maybe up to 3%, but generally it's between 1 and 2, just depending on who you're investing with. And this is of the purchase price. So if I'm doing a $10 million deal, we charge a 1.5% acquisition fee, which is $150,000 at the very front end of the transaction. And then there's an asset management fee. This is for managing the managers at the asset and ensuring that the investment returns are actually being the main focus for the investors. This ranges between 1 up to even 5% of the equity contributed or gross profits. Generally, you see a refi or construction fee being baked into there, and a disposition fee. Generally, this is 1, maybe 2% of the sales price. Again, for taking the property all the way through and finding a buyer to come in and pay you your desired price. And then lastly, profit split. This is where you make all of the money. Because you could do deals that are $1 million, $10 million, or even $100 million or plus, it all works the exact same. And if you do your job and you perform really well, you can get a performance bonus, is basically what a profit split is, of all of the profits generated. If we buy a deal for $10 million and we sell it for $15 million, that's a $5 million profit. we do a 70-30 profit split on that $5 million. So 3.5 of that $5 million goes to the investors that are completely passive, plus they get their cash flow and tax advantages. And then $1.5 million comes back to us and the other GPs that we partnered with for doing the project. And it works the exact same if you did a $100 million deal as well. So you can see why guys like us like to get into this business and stay in this business and just focus on getting bigger. Now that we're on the back end of it, my goal is that you found a tremendous amount of value of breaking it out in each different category of the business. There's a lot of moving pieces in multifamily or commercial real estate in general. My goal is to make it as simple as possible for you. So I want to know, what questions do you have, or what do you want us to do separate videos on within these categories? Which ones do you want us to dive deeper into? And as always, if you found any value in today's video, make sure you drop a like, comment, and most importantly, subscribe, and I will see you on the next one.